As the Federal Reserve meets to discuss interest rate policy, we're chatting with three experts at the Peterson Institute for International Economics in Washington, D.C. Joining me is Joe Gagnon. He's a senior fellow here, formerly with the Treasury and the Federal Reserve. We also have Angel Ubide. He is a central banking expert. He also worked at several hedge funds. And Pedro da Costa has covered central bank policy for several years. As a former journalist at Reuters and the Wall Street Journal, he is now an editorial fellow at the Institute. So good to have you all here. And you're in unanimous agreement. There will be an increase. Is the economy ready?
I think so, although it is a close call. But I think it'll be very important the Fed keep an eye and not go too fast next year. But I think, it's time to start maybe.
Pedro, you think it's a close call?
I'm going to take the dovish side of the argument and say I don't think the economy is ready. The Fed has always argued that raising interest rates would be a sign of confidence in the economy. It would be a sign that the recovery had reached quote-unquote escape velocity, meaning that it had self-sustaining momentum. And this is in fact what my colleague Dave Stockton called a grudging interest rate increase. And so I don't think that the Fed has really made the case for why they need to go at the moment. I don't see it.
Now, I think from the point of view of the economy is ready. It's just inflation that is low. So in some sense, for me, the Fed has the luxury to choose when to start raising rates. It can start now and go slower. It can start a little bit later and go a little bit faster. But from the point of view of the real economy, I think the real economy is perfectly ready.
And that's even with oil prices falling again, and we've certainly seen some financial market disruption with junk bonds. And we heard from Janet Yellen not long ago that problems in Europe kept them on the sidelines. So why wouldn't that be taken into consideration?
Well, I think the answer is that the employment growth has been steady throughout, and we had a lot of problems, during the year, and still it didn't seem to dent employment growth in the United States. So obviously they'll be keeping a close eye on that going forward. But with 200,000 jobs a month, I think the economy should be able to withstand a small increase.
What about that dual mandate, though, the inflation picture?
Well, I think that's the one, right? If I were voting, maybe I would ask you, I would wait and see, because we've been forecasting the pickup in inflation the last year and a half, and it hasn't happened. So there is clearly something we don't completely understand about the behavior of inflation. You can wait. But at the same time, I think the economy is robust. It's a sectoral issue, right? The US economy has become an energy-intensive economy. The oil sector is suffering, but the non-oil sector is doing really well. So,
but I would argue that the low inflation picture actually reflects the fact that the unemployment problem is much larger than we suspect, and that the labor market is much further from full employment than it was, before the crisis. And so that could be one of the reasons why inflation is so low, and one of the reasons why wages aren't picking up. And if you look at it from that perspective, then the wait and see attitude would be, more advisable. And but to Joe's point, as far as the international scenario buying them, giving them room to move, there was another major factor that Janet Yellen outlined, which was China. And Joe and I had this conversation. He said, well, if China doesn't fall out of bed, then you raise interest rates. And in fact, that's kind of what's happened. China hasn't fallen out of bed, and the Fed's actually lucky they got a pretty decent streak of data this week from China. So that gives them, at least from the international front, it gives them the cover. But I'm again worried more about the domestic picture.
With this one, on inflation, I would say it has been surprisingly low for a while. But we just had a new release today of the core consumer price, CPI inflation, which is not the exact measure they target, but it's going up. Mm-hmm. And in a 3-month basis, it's actually above their target of 2. Now, again, that's not the exact measure they look at, but the trend, I think, is okay.
And to be honest, from a tactical standpoint, right, I'd rather start raising rates when I can control the pace than being forced to increase rates because inflation all of a sudden surprises to the upside.
And then you're behind the curve.
Exactly. Right. So I think they are in a very good situation to essentially start and then control the tempo. If they start and they don't go again for another 6 months, fine. If they start and they have to go in another 3 months, fine too.
And you all think there will be rate increases. It's not going to be one and done, in your view, right? We're looking at several increases next year.
I think the Fed would be very loath to stop raising rates or to reverse course, and it would take a very severe downturn for them to change their minds. The Fed doesn't take it. That's one of the reasons they've waited so long, is they don't they don't see this something as a decision they could reverse very quickly. And they see their credibility as being on the line. And once you start a tightening cycle, they intend to move higher. Now, I actually did my own little Twitter poll today. How many moves for the year? 1, 2, 3, and people are all over the place. People really don't know. And that's going to become the new question is, are they going to go in March? Are they going to go in April?
Well, Angel, let me draw upon your hedge fund background for a moment. So what does that do with the markets? Because the markets like certainty. So if everyone's going to guess what happens after this meeting in December, does that mean we're in for continued volatility, or does the market say, oh, things must be great, the Fed is raising rates?
I mean, it's fully priced in, right? So I think whatever volatility was supposed to happen, we already have it. The question is going to be, depending where the dots chart fall and the communication afterwards, the market is pricing really only a couple of hikes next year. I personally think we are going to get more than that. But this is similar to what happened in 2004. The market essentially was catching up with the Fed back then, and I think it's going to be catching up with the Fed now.
Is it going to be this easy, though? Because, Joe, look at Japan, for instance. I mean, it's hard to go from zero. Is it going to be different this time in the U.S.?
Well, we certainly have seen countries that tried to raise rates in the past few years and then had to reverse course, and I'm sure the Fed really doesn't want that to happen, as people said. I think they have waited longer objectively than other countries did, so let's hope they're right. But ultimately, to me, the risk in terms of what might cause them to reverse course is the dollar. They obviously, the strong dollar has obviously been a big factor in why they've waited so long already. And I don't think they're really forecasting any further strength in the dollar. I think they're forecasting it to stay where it is. If it continues to go up, that to me would almost certainly cause them to pause.
Is there a problem beyond the markets? Do consumers stop taking out mortgages? Do businesses stop going for loans? Or will these increases be incremental enough that the economy absorbs it just fine?
It depends on how the market reacts, right? Because a quarter point, everybody talks about a quarter point is just a quarter point, but the market might try to price in a greater extent of rate increases, and that might be particularly the case if we get a string of really positive economic data early next year. The market might think, hey, the Fed will find itself behind the curve by the time we get to summer, so the market could start to price it. So if you have a significant jump in the Treasury market rates, that would affect mortgage rates. A quarter point, probably not.
Yeah, I agree, and I think that can only happen if it's really an inflation surprise. If it's a growth surprise, it's fine. The Fed will simply be catching up with growth. It's if we collectively have been completely wrong on inflation, and all of a sudden inflation just moves up to normal, and then there could be a little bit of fear there.
Does it matter there's divergence in central bank policy right now? Big divergence around the globe?
I don't think it matters from an economic point of view, but it certainly must be what's been pushing the dollar up against other currencies so far. And I worry that even though it's sort of priced in, markets understand this now, so some theories say it's priced in, but I think there's some evidence that there could be lingering pressure on the dollar if this goes on for a long time, which it looks like it will.
Gentlemen, whatever happens when this announcement is made, whatever happens next year, we are going to conclude an unprecedented time in terms of central bank policy in the U.S., in markets, a scary time. I'm going to go around the circle, starting with you, Pedro. Have we now put to rest the question of whether QE worked or not? Is this going to be the most brilliant couple of years we've seen by the Fed?
I think that the economics community, there's a strong majority within the economics community that agrees that QE worked and that it at least buffered us from the worst of the recession. But politically, that's a very tough sell. And I think in Washington, there's certainly that has not been in agreement. And that's one of the reasons the Fed still faces political pressure from both sides, because QE actually became erroneously associated with bank bailouts. People came to associate monetary policy with direct capital injections into banks, which are two completely different things. But it was an easy sell politically if you wanted to make the Fed look bad.
Angel?
I think it has worked. It's a resounding yes. It has strengthened growth. It has prevented inflation from going down. It hasn't generated any moral hazard on fiscal policy, which was one of the fears many people had, that deficits were going to be rampant. And if anything, it has been the opposite. I don't think personally it has generated any financial stability risk. There are some asset prices that may be more or less expensive, but they are not completely out of whack. And I think it has worked very well.
And finally, Joe.
Well, look, I can't say it any better than what Angel just said. I completely agree with everything he said. I would just add, in economics, economists are famous for disagreeing, but studies of this issue are overwhelmingly in agreement that QE does work.
Gentlemen, we end it there. I so appreciate your expertise in what's really a very fascinating time for the central bank. Thank you so much.
Thank you.
Thank you.
I'm Rhonda Schaffler for TheStreet.